All right. I want you to picture a split screen in your mind.
Okay.
On the left, you've got the price action from the last 24 hours. And it is ugly. It's violent. It looks like the sky is falling.
It does. A sea of red.
But on the right side of that screen, you have the actual plumbing of the financial system being rewired in real time by the biggest players on the planet.
That's the paradox, isn't it? It's the defining paradox of this whole cycle. The price is absolutely screaming recession, but the infrastructure, the deep level stuff, it's screaming adoption.
And normally we try to weave these things together, but I think today we really need to look at them separately. The signal is just getting lost in the noise.
I agree.
We have a lot to get through. A jobs report that feels, frankly, like a hallucination. A technical breakdown in Bitcoin's market structure. And then this move by BlackRock that I don't think has been priced in at all yet.
And we have to start with that macro event, that head fake from yesterday. It was a textbook rug pull.
Right. So let's start with that left side of the screen, the pain. The U.S. economy, on paper, added almost double the expected jobs in January.
Yeah, the headline number was 130,000 jobs. Consensus was way down at 70,000. So at first glance, you think, wow, this economy is booming.
And for a few minutes, the market thought so too.
Oh, for about 15 minutes, the algorithms bought it completely. You saw that immediate wick up in prices. The bots just read the headlines, saw the word growth, and smashed the buy button.
But then the human stepped in.
Correct. The humans started reading the footnotes, and that's where the whole narrative just collapsed.
Okay, let's get clinical on this.
Yeah.
What exactly did the Bureau of Labor Statistics bury in the fine print? Because the reaction wasn't a growth reaction. It was panic.
It was the revisions. This is that ghost data we've talked about before, but this time, I mean, this was egregious. The BLS went back and revised the data for all of 2025.
The entire year.
The entire year, downward. They effectively erased 403,000 jobs from the record.
Wait, hold on. That's nearly 500,000 jobs? You're saying for a whole year, the official story was job growth, and now a year later, they're saying, oops, actually, never mind.
That's basically it. It's the lag effect in government data, but the implication is just massive. It means the robust economy narrative of 2025, it was a fiction.
So what was the reality?
The reality was stagnation. The U.S. economy was only averaging about 15,000 jobs a month. That's stall speed.
Okay, so the economy is actually weaker than we thought. But hang on. Usually, bad news is good news for markets, right? It means the Fed has cover to print money. Why did this tank everything?
Because of what we call the policy trap. This is the absolute nightmare scenario for the Federal Reserve. You have this weak historical reality from the revisions.
Right.
But the current data, the January report, showed wages rising by 0.4% month over month.
Inflation.
Exactly. Sticky, wage-driven inflation. So the Fed is completely handcuffed. They see a slowing economy that desperately needs rate cuts, but they see rising wages, which demands they keep rates high.
They can't cut into that. If they do, they risk inflation coming right back 1970s style.
They're terrified of it. And the market priced that realization in instantly.
Yeah, I saw the probability for a March rate cut.
Yeah.
It just fell off a cliff.
It collapsed. We went from, what, a 20% chance of a cut down to just 7.5%, basically overnight.
Wow.
So the market's takeaway was, the Fed isn't pivoting in March. Higher for longer is back. And when rates stay high,
The dollar spikes. Treasury yields spike.
and liquidity gets sucked out of risk assets. That's the macro gravity that just pulled Bitcoin straight down from $69,000.
Okay, so that's the macro setup. The Fed is paralyzed.
Yeah.
But let's talk about the structural damage to Bitcoin itself. We didn't just slide, we broke through some serious floors.
We did. We have to talk about price topology here. Bitcoin lost the 200-week exponential moving average, the EMA. It was sitting right there at $68,000.
So why is that specific line the do or die level?
Yeah.
I feel like we hear about a new critical line every other week.
This one is different, you know? The 200-week EMA, that's the big one. It's the institutional line in the sand that separates a secular bull market from a bear market.
So above it, you buy dips. Below it.
Below it, you sell rallies. It fundamentally changes the algorithmic behavior of the entire market. Losing that level is a very big deal.
And right now, we're just hovering. What, 66, 67,000? Is there any support here, or are we just in free fall?
We're kind of in a liquidity vacuum. Looking at the order books, the real heavy buyer interest, you know, the big limit bids, they don't really show up in size until you get down to maybe $62,000.
That's a long way down. But are we getting overextended? I saw a stat about the RSI that looked Well, historic.
It is. It's probably the most extreme reading we have seen in years. The daily relative strength index hit 15.9.
15.9. Could you put that in context for us?
Sure. It is the sixth lowest reading since 2015. The only times it's been this low were the COVID crash in March 2020 and the absolute final bottom of the 2018 bear market.
So statistically, this is where the rubber band should snap back.
Statistically, yes, usually. But you know the saying, markets can stay irrational longer than you can stay solvent.
Right.
And that's why you're seeing this panic premium just skyrocket in the options market. The cost to protect your downside, it's blowing out. It's pure, unadulterated fear.
Well, it's not just fear. For some people, it's an existential crisis. Let's talk about the miners. If the price is dropping this hard, their revenue has to be in the toilet. How bad is the squeeze?
It is brutal. We are witnessing a capitulation event in real time. Just look at hash price. That's the metric that matters for them. It's revenue per unit of computing power.
And it crashed.
It crashed to 0.034 fort per terahash.
Which is really low.
It's a catastrophe. It's down 35% year over year. At this level, unless you have basically free electricity and the absolute newest machines, you are losing money every single second you're turned on.
So what do? Just turn them off?
The inefficient ones do, yeah. We call it unplugging. But before they unplug, they do something else. They sell their treasury.
They dump their Bitcoin.
They have to. They've got OPEX, right? Electricity bills, debt service on all the rigs they bought last year. When revenue craters like this, they become forced sellers. It creates a nasty feedback loop.
The death spiral. Price drops.
Hash price drops. Miners sell their Bitcoin to pay the bills, which pushes the price down even further. And we're seeing it in the hardware market, too. Prices for efficient rigs have dropped 23%. They're not just selling Bitcoin, they're liquidating the actual machines.
That's the definition of giving up.
It is. It's capitulation.
So we have the Fed handcuffed. Technicals are broken. Miners are dumping inventory. That's the left side of our split screen, a total bloodbath. But now, let's turn to the right side. Because the flow data is telling a very, very different story about who is selling and who is buying.
This is where it gets really fascinating. We saw a violent reversal in the ETF flows. After 3 solid days of inflows, suddenly, boom, $276 million left the U.S. spot ETFs on February 11th.
Okay, so the ETFs are selling too. That seems to fit the bearish narrative.
Not exactly. You have to break it down. Who was selling? It was Fidelity, losing $92 million. It was ARK, losing $70 million.
The funds favored by retail and tactical traders.
Exactly. People who trade the news, they saw the Fed data, they got scared, and they clicked sell. It's fast money running for the exits.
Okay, but where does the story change?
It changes when you look at BlackRock. You look at BUIDL.
They were green, weren't they?
They were green. While everyone else was bleeding out, BlackRock's ETF took in another $73.4 million in net inflows.
Just stop and think about that. The market is crashing, fears at a cycle high, and the clients of the world's largest asset manager are buying. What signal does that send?
We call it wrapper consolidation. The capital is fleeing the smaller issuers and consolidating into the main liquidity vehicle. But more importantly, it tells you the BlackRock client, the strategic allocator, is not panicking. They're using this dip to accumulate.
They are taking the other side of the trade from the retail panic.
That's exactly what's happening. And BlackRock isn't just buying coins, they're rewiring the whole system. We have to talk about that Uniswap announcement. It feels like it got buried, but this is huge.
It is. So on February 11th, BlackRock's BUIDL fund, which is basically tokenized U.S. treasuries, integrated with something called UniswapX.
Yeah.
For the listener who hears Uniswap and immediately thinks risky crypto casino, can you explain what this actually means? Why is BlackRock hooking up with a decentralized exchange protocol?
Because they want the plumbing. Think about it. Right now, if you want to trade a U.S. Treasury, you are stuck with banking hours. You have settlement delays. It's a T+1, T+2 world. It's analog. It's slow.
And this makes it digital.
This makes it digital. By integrating with Uniswap, they're essentially saying, we want U.S. Treasuries to have the speed and the 247 liquidity of a crypto token.
So you could trade U.S. debt on a Saturday night.
You could. And you get composability.
Okay, cut the buzzwords. What does composability actually let a trader do that they couldn't do yesterday?
It means the asset can talk to other applications automatically. You could, for instance, use your tokenized treasury as collateral for an instant loan on a DeFi protocol. No paperwork, no bank manager. It bridges the safety of U.S. debt with the velocity of decentralized finance.
Wall Street safety, crypto speed.
That is the holy grail. And the market got it. The UNI token, Uniswap's governance token, rallied 20% while everything else was crashing.
Because the market sees this as validation.
Massive validation. And BlackRock didn't just use the protocol, they revealed a strategic investment in the Uniswap DAO. They're not just using the rails, they're buying a stake in the railroad company.
So on one screen, prices are a disaster. On the other, BlackRock is literally merging TradFi and DeFi. And they're not the only ones ignoring the price action. Corporate treasuries are stepping in.
The corporate buy the dip is a real phenomenon. While those ETFs saw net outflows, public companies were buying. DDC Enterprise bought another 100 BTC. That's their 5th week in a row. They just don't care about the daily chart.
They're price agnostic.
Completely. They're looking at cost of capital arbitrage. If they can issue stock at a low cost, or use cash flow that's just getting eaten by inflation and swap it for a hard asset like Bitcoin that just went on sale, they see it as a huge win. They're just lowering their cost basis.
It's a balance sheet play for the next 5 years, not a trade on the next Fed meeting.
No, not at all.
Speaking of the next 5 years, we have to zoom out globally. While the U.S. is sort of stuck in the mud with this data and regulation, other places are making big moves. Let's talk about Abu Dhabi.
This plugs right back into our split screen theme. The U.S. regulatory environment is uncertain, and Abu Dhabi sees that as a massive opportunity. They just put out what they call discussion paper number 1 of 2026.
And what's the headline from that?
The headline is clarity. They have officially classified Bitcoin mining as a commercial activity, not a financial service. But the absolute game changer is that they defined mined tokens as property.
That sounds like a boring legal distinction. Why does calling it property matter so much?
Because of what you can do with property. You can put a lien on it. You can use it as collateral for a loan. So a miner in Abu Dhabi can take the Bitcoin they've mined, which is now legally their property, and use it to get a loan to buy more hardware to expand their operations.
Whereas in the U.S.?
In the U.S., it's a gray area. Is it a security, a commodity? Can a bank even touch it? The regulatory friction is enormous. Abu Dhabi is just removing the friction. They're playing regulatory arbitrage. They want to be the global headquarters for the mining industry.
And the paper mentioned extraterritoriality, didn't it? That sounded really ambitious.
Very. They want to regulate global mining fleets that are managed from Abu Dhabi. So even if your machines are physically in Texas or Paraguay, if your HQ is in their jurisdiction, you get their legal protections. They're building a safe harbor while other countries are building hurdles.
Okay, so let's bring this all back. Let's merge that split screen. We started with this paradox. Strong data, but a crashing market.
The macro mirage. The data paralyzed the Fed, which spooked the short-term traders. The fast money just hit the eject button, and that's why we're at $67,000. That's why the RSI is at 15.9.
But the smart money, the BlackRocks, the corporate treasuries, the sovereign entities like Abu Dhabi, they're not looking at the RSI.
No, they're looking at the infrastructure. They're building the pipes for the next decade of finance. BlackRock integrating with Uniswap is a signal. Abu Dhabi clarifying property rights for miners is a signal.
So the price is crashing because the weak hands are being shaken out. But the floor is quietly being built by the strongest hands in financial history.
That is the split-screen reality we're living in right now.
So here's the question I want to leave you with today. And it's not just who is less to sell. It's more personal than that. If BlackRock is buying while the market is in a full-blown panic, and if corporations are accumulating while you are staring at a very red chart, you just have to ask yourself, are you the smart money in this equation, or are you the liquidity they're happily consuming?
That's the uncomfortable question every single investor needs to answer for themselves right now.
Keep an eye on the CPI data next. That's the final card the Fed has to play before their March decision. Until then, try to watch the plumbing, not just the price. Thanks for joining us for the deep dive.